You're listening to Investor Insights Decoded, the podcast where our hosts, Michael Grant and Julia Foster, break down the most impactful memos from the world of investing. Today, we'll be exploring Howard Marks's memo, Genius Isn't Enough, and other lessons from long-term capital management, written on the 9th of October, 1998. Let's dive into the timeless insights that continue to influence investors today. And if you're enjoying the content, don't forget to like, subscribe, and share your thoughts in the comments. Your support helps us bring more valuable insights to the investing community. Now, let's get started. Welcome back, everyone. Today, we're going to dive deep into a pretty fascinating story, the story of long-term capital management. You might have heard of them. They were like the ultimate financial dream team back in the 90s, packed with geniuses, Nobel Prize winners, you name it.
Yeah, they had it all. Former central bankers, top academics, Wall Street veterans. It really seemed like they had cracked the code to market success.
But then 1998 hit, and let's just say it didn't end well. So what happened? How did this dream team go from like financial rock stars to a cautionary tale? That's what we're going to unpack today, using Howard Marks's memo, Genius Isn't Enough, as our guide.
It's a story that really highlights how even the brightest minds can stumble in the market, and it offers some crucial lessons for investors of all levels.
Okay, so LTCM, they were pulling in like insane returns in their early years, 40% annually, something crazy like that. What was their secret sauce?
Their main strategy was something called bond arbitrage. Basically, they tried to find two bonds that were essentially identical in terms of risk and maturity, but were priced differently by the market.
So they were looking for mispricings, like discrepancies in how the market was valuing these bonds.
Exactly. And they would buy the undervalued bond and simultaneously short sell the overvalued one. They were betting that those prices would eventually converge.
So kind of like betting that the market would eventually correct itself and those prices would even out.
That's the idea. And to supercharge their returns, they used leverage, borrowing massive amounts of money. It's like putting a multiplier on your bets.
Ah, and that leverage is what ultimately led to their downfall, right? Like when things went south, it all amplified those losses.
It was a major factor, for sure. They borrowed so much that even a small miscalculation could have huge consequences. And that's exactly what happened in 1998.
1998, the year it all came crashing down. What specifically triggered it?
Well, it was a combination of factors. But the main catalyst was the Russian government defaulting on its debt. It sent shockwaves through global markets, leading to a flight to quality.
Flight to quality, meaning?
Investors suddenly got scared and started dumping riskier assets, piling into safer ones like U.S. Treasuries. And guess what? LTCM was heavily invested in those riskier assets.
Oh, so their models didn't see this coming.
Not at all. They were totally blindsided. They relied on historical data and complex computer models, what Marks calls black boxes.
But those models didn't account for this kind of like unexpected event.
Exactly. And because of their massive leverage, those losses snowballed out of control. They were forced to liquidate their positions at fire sale prices. It was a complete meltdown.
So what's the takeaway here? Does this mean bond arbitrage is inherently risky?
Well, any strategy involving leverage carries inherent risk. But Mark's point is that even strategies that seem low risk can blow up if you're not careful.
Okay, so it's not just about the strategy itself, but also about how you manage the risk associated with it.
Exactly. And a big part of that is recognizing that no model can perfectly predict the future. Markets are complex, they're constantly evolving, and they're influenced by a myriad of factors, including human emotions.
So those black boxes, those fancy algorithms, they're not foolproof.
Not at all. They can be helpful tools, but they're only as good as the data they're based on and the assumptions built into them. And as we saw with LTCM, when those assumptions prove wrong, the consequences can be devastating.
This whole story, it's almost like a Greek tragedy, like hubris leading to downfall. These guys were so brilliant, so confident in their intellectual prowess that they underestimated the inherent unpredictability of the market.
That's a great point. And Marks argues that their intellectual arrogance might have even fueled their risk appetite.
Okay, so even if you have a team of like financial superheroes, having good risk management is arguably even more important.
Right. Absolutely. And one of the core principles of good risk management is understanding that no strategy can eliminate risk entirely.
So how do you balance that? How do you embrace the potential for gains while also managing the potential for losses?
It's about finding that sweet spot between being too cautious and being too reckless. And a big part of that is understanding your own risk tolerance.
Okay, so knowing how much of a drop in your portfolio you can handle without like uh, freaking out and making impulsive decisions.
Exactly. And then structuring your investments accordingly. Diversifying your portfolio, avoiding excessive leverage, having a plan for managing losses. These are all key elements of a sound risk management framework.
Right. So don't put all your eggs in one basket and don't bet more than you can afford to lose. Solid advice, really. But you mentioned leverage. That was a big part of LTCM's downfall.
Mhm.
When does leverage make sense and when does it become like a ticking time bomb?
Well, leverage can be a powerful tool when used wisely. It can amplify your gains. But the flip side is that it can also amplify your losses. And that's what happened with LTCM.
So how much leverage is too much? Is there like a magic number?
There's no hard and fast rule. It depends on your individual circumstances, your risk tolerance, and the specific investment. But generally speaking, the more leverage you use, the greater the potential for both rewards and risks.
Okay, so it's a trade-off. More potential upside, but also more potential downside. And this all seems super relevant to us regular folks too, not just hedge fund wizards.
Yeah.
What are some actionable takeaways we can apply to our own investing?
Well, one key takeaway is to be wary of any investment that promises exceptionally high returns with low risk. If it sounds too good to be true, it probably is.
Right, no free lunches.
Exactly. Another key takeaway is to diversify your investments. Don't put all your eggs in one basket. Spread your money across different asset classes, sectors, and geographies.
Okay, classic diversification advice. But even LTCM was diversified, right?
Mhm.
And it still blew up. So what's the lesson there?
They were diversified across asset classes, but their models were still interconnected in a way that made them vulnerable to a systemic shock.
So it's not just about the variety of your holdings, but also the relationships between them.
Exactly. You need to consider how those assets might move together in different market environments.
So if one thing goes wrong, it doesn't set off a chain reaction that takes down your entire portfolio.
Precisely. And another crucial takeaway is to be mindful of the fees you're paying. High fees can eat into your returns, especially over the long term.
Yeah, those pesky fees. Always got to watch out
Yeah.
for those. So what else? Any other nuggets of wisdom we can glean from LTCM's demise?
Well, this might sound obvious, but it's worth emphasizing. Don't invest in things you don't understand. If you can't explain an investment strategy in simple terms, you probably shouldn't be investing in it.
Right, no blindly following the crowd or jumping on the latest bandwagon. Do your homework.
Exactly. And finally, remember that investing is a marathon, not a sprint. Focus on the long term. Don't get caught up in the short-term noise of the market.
So patience, discipline, and a long-term perspective. Those are key ingredients for success. Okay, so we've talked about diversification, risk management, fees, understanding your investments, and having a long-term focus. But all of this, assumes we can make rational decisions, right? But humans aren't always rational. We're driven by emotions, by biases.
That's a crucial point, and it's something Marx delves into in his memo. He talks about the dangers of too little fear in the market.
Too little fear. But isn't fear like a bad thing in investing? It can lead to panic selling and bad decisions.
Fear can be a problem, but so can a lack of fear. When investors become too complacent, too confident, they tend to take on more risk than they should.
It's like that saying, bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria.
Exactly. When everyone's feeling euphoric, when there's no fear of loss, that's usually a sign that the market is getting ahead of itself.
So a healthy dose of fear can actually be a good thing. It keeps you grounded. It makes you think twice before taking on too much risk.
Exactly. It helps you stay disciplined and avoid those impulsive decisions that can lead to big losses. And Marx argues that in the late 1990s, there was a widespread lack of fear in the market. Interest rates were low, the economy was booming, and investors were pouring money into anything that seemed remotely tech-related.
The dot-com bubble.
Precisely. And LTCM got caught up in that euphoria. They leveraged themselves to the hilt, believing that their models could navigate any market conditions. But they underestimated the power of human emotions, the potential for irrational exuberance to drive markets to unsustainable levels.
So even the smartest people can get swept up in the hype.
It happens to the best of us. And that's why it's so important to be aware of our own biases, our own emotional triggers, and to develop strategies for managing those emotions.
Okay, so how do we do that? How do we, keep our emotions in check when the market's going crazy?
Well, one helpful technique is to have a written investment plan. Outline your goals, your risk tolerance, your strategy. That way, when the market gets turbulent, you can refer back to that plan to keep yourself grounded.
So it's like having a roadmap to guide you through those emotional storms.
Exactly. Another helpful strategy is to focus on the long term. Remember that market fluctuations are normal. Don't get too caught up in the day-to-day noise. Stay focused on your long-term investment goals.
Okay, so patience and discipline are key.
Absolutely. And if you're feeling overwhelmed or uncertain, don't be afraid to seek out advice from a financial professional. Sometimes having an objective third party can help you make more rational decisions.
Great advice. So we've talked about the dangers of leverage, the limits of models, the importance of humility, and the need to manage our emotions. But Marx also emphasizes the importance of learning from history.
He does. He argues that many of the mistakes we see in the markets are simply replays of past errors.
It's like that saying, those who cannot remember the past are condemned to repeat it.
Exactly. And Marx points to numerous examples throughout history where excessive optimism, leverage, and a disregard for risk led to painful consequences.
So we need to study the past to avoid making the same mistakes in the present.
Precisely. By understanding the causes of past market bubbles and crashes, we can better recognize the warning signs and make more informed decisions.
Okay, so crack open those history books, study those market cycles, and learn from the mistakes of those who came before us.
Exactly. Because as Mark Twain supposedly said, history doesn't repeat itself, but it often rhymes.
Love that quote. So we've covered a lot of ground in this first part of our deep dive, from the downfall of LTCM to the limits of intellect and the dangers of leverage. But before we move on, I want to leave you with a question to ponder. If even a hedge fund filled with Nobel Prize winners can fall prey to market forces, what does that tell us about the importance of risk management and humility in our own investing decisions?
It's a question worth reflecting on, and it's one we'll continue to explore in the next part of our deep dive. That question about LTCM, these Nobel Prize winners falling prey to market forces, it really highlights how psychology plays such a huge role in investing, even for the supposedly smartest folks in the room.
We were talking about how even with all their brain power, they got caught up in that irrational exuberance of the late 90s.
Right, and one of the things that contributed to their downfall was falling prey to common cognitive biases, those mental shortcuts that can really distort our thinking and lead to poor decisions.
Okay, let's break that down a bit. What are some of those biases that investors should be aware of?
Well, one that really jumps out, especially in LTCM's case, is confirmation bias. It's that tendency we all have to look for information that confirms our existing beliefs and kind of ignore or downplay evidence that contradicts them.
But we see what we want to see, even if it's not really there.
Exactly. And for LTCM, their early success with bond arbitrage, it probably reinforced their belief that their models were, infallible. They might have started overlooking those potential weaknesses or dismissing any warning signs that suggested their strategy could be flawed.
So their success kind of blinded them to the risks they were taking.
Yeah, I think that's a fair assessment. Another bias that might have played a role is anchoring bias, the tendency to overemphasize the first piece of information we get on something, even if it turns out to be, irrelevant or outdated.
So getting fixated on an initial idea or impression.
Exactly. And LTCM's models, they relied heavily on historical data. And while historical data can, it can be useful, it's not always a reliable predictor of the future, especially in a constantly changing environment like the financial markets.
Right. So they might have been clinging too tightly to those historical relationships, even when the market dynamics were shifting around them.
That's a real possibility. And of course, we can't forget about herd mentality, that urge to follow the crowd even when it's heading in a dangerous direction.
Right, like if all your friends jump off a bridge.
Mhm.
But investing is different, right? You can't just blindly follow what everyone else is doing.
You absolutely have to think for yourself. And that's where independent thinking becomes so crucial. It's not about, being contrarian just for the sake of it. It's more about being skeptical of conventional wisdom, questioning those assumptions, and looking for opportunities where the prevailing sentiment might be wrong.
So how can investors cultivate that independent thinking?
It starts with being aware of our own biases. Once we understand how these mental shortcuts can influence our thinking, we can start to, challenge them, ask tough questions, seek out information from diverse sources, be willing to consider viewpoints that differ from your own.
So it's about being open-minded,
Yeah.
right? And having that intellectual humility we talked about earlier. But it's also about having conviction in your own analysis, right? Once you've done your due diligence, don't be afraid to take a stand.
Exactly. It's about finding that balance, being open to different perspectives, but also trusting your own judgment. And and that brings us back to risk management. It's not just about minimizing risk, it's about managing it intelligently.
Right. And Marx really goes into detail in his memo about LTCM's risk models. What went wrong there? Were the models themselves flawed, or did LTCM just kind of ignore their own warnings?
That's a great question, and it's something that people still debate. The models were incredibly complex. They were based on sophisticated mathematical formulas, mountains of historical data. The problem was they were designed to work in, like, quote unquote, normal market conditions.
They didn't account for those black swan events, those really rare extreme events that can kind of turn everything upside down.
Exactly. They were caught totally flat-footed when that Russian debt crisis hit. It exposed a major flaw in their risk management. They underestimated the possibility of extreme events, and they didn't build in enough safeguards to protect themselves.
So even the best models can be blindsided by reality.
Absolutely. No model can perfectly predict the future, and that's a crucial lesson for investors. You need to be aware of the limitations of those models, understand their underlying assumptions, and be prepared to adjust course when reality deviates from those predictions.
So it's about using models as a tool, but not like a crutch.
Exactly. Don't blindly follow the output of any model, no matter how sophisticated it seems. Always apply your own judgment, your critical thinking skills.
And that goes back to humility again, right?
Absolutely. Recognizing that no model is perfect, that we don't have all the answers, and that we need to be prepared for the unexpected.
Okay, so we've talked about the limitations of models. We've talked about humility. But Marx also talks about, so he calls too little fear. What's he getting at there?
He's talking about how a lack of fear, often driven by, overconfidence or complacency, can lead investors to take excessive risks.
It's kind of counterintuitive, right? You'd think fear would make people more cautious, not less.
It is. It's a bit of a paradox. But when markets are booming, when everyone's making money, it's easy to get swept up in that euphoria and forget about those potential downsides.
Yeah, it's like that feeling of invincibility you get when things are going well. You start thinking nothing can go wrong.
Exactly. And that's when we're most vulnerable. Marx argues that a healthy dose of fear is actually a good thing. It helps us stay grounded, think critically, and avoid taking on more risk than we can handle.
So it's about finding that sweet spot between fear and greed, right? Like not being paralyzed by fear, but also not letting greed cloud your judgment.
Exactly. We need to acknowledge those emotions, both fear and greed, and develop strategies for managing them so they don't hijack our decision making.
Okay, that makes sense.
Yeah.
How do you actually manage emotions in investing? It's not like you can just turn them off.
It's definitely a challenge, but there are techniques you can use. One is to have a clear investment plan and stick to it. Write down your goals, your risk tolerance, your strategy. That way, when the market gets turbulent, you can refer back to that plan to keep yourself anchored.
So it's like having a roadmap to help you stay on course when things get bumpy.
Exactly. Another strategy is to focus on the long term. Market fluctuations are inevitable, but over time, the market tends to trend upwards. So if you have a long-term investment horizon, those short-term dips become less significant.
Right. Don't panic and sell everything when the market takes a dive.
Exactly. Remember that time is on your side, and stay focused on those long-term goals. Another helpful technique is to practice mindfulness, being aware of your thoughts and emotions in the present moment without judgment.
Mindfulness. Isn't that more of a meditation thing?
It is. But it can be incredibly valuable for investors too. When you're feeling anxious or fearful, take a few deep breaths. Observe those emotions. Remind yourself that those feelings are temporary.
So it's about stepping back from that emotional roller coaster of the market and gaining some perspective.
Exactly. And finally, don't be afraid to seek out support. Talk to a financial advisor, a therapist, even a trusted friend or family member. Getting that outside perspective can really help you manage your emotions and make more rational decisions.
So it's okay to ask for help.
Absolutely. Investing can be an emotional roller coaster. And there's no shame in seeking out guidance and support.
Great advice. Now, we've talked a lot about things that seem relevant to, individual investors like you and me, but Marx is also talking to professional investors in this memo. What's he saying to them?
He's reminding them that, even the best investors make mistakes, that no one has a perfect track record. He's urging them to cultivate humility, to constantly question those assumptions, and to always be learning and adapting.
So basically, don't let your ego get in the way of making sound decisions.
Exactly. And he's also encouraging them to understand the limitations of their models and to be prepared for those unpredictable events that can disrupt even the most carefully crafted strategies.
So it's a message of caution, but also of empowerment, right?
Yeah.
We can't control everything, but we can control how we respond to those challenges.
That's a great way to put it. It's about cultivating a mindset of resilience, adaptability, and continuous learning.
Now let's shift gears a bit and dive into some of Mark's specific recommendations for investors. What are some of the actionable takeaways from this memo?
Well, one of the most important things he talks about is being wary of excessive leverage. As we saw with LTCM, leverage can really magnify both gains and losses.
Right, it's a double-edged sword. So how much leverage is too much? Is there like a rule of thumb?
There's no hard and fast rule. It depends on your individual circumstances, but I think the key is to understand the risks involved and to use leverage judiciously. If you're borrowing money to invest, make sure you can comfortably handle those debt payments, even if your investments decline in value.
So don't bet the farm, so to speak.
Exactly. Another key recommendation is to recognize the limitations of those models and those historical relationships when you're trying to predict the future. We've already discussed this, but I think it's worth emphasizing again.
So don't get seduced by those fancy algorithms and back-tested returns.
Exactly. Use models as a guide, but always combine those insights with your own judgment and experience.
So blend the quantitative with the qualitative.
Precisely. And remember that past performance is not necessarily indicative of future results. Just because a strategy worked in the past doesn't mean it will continue to work in the future.
Right. That's something you see in those investment disclaimers all the time. But it's easy to overlook.
It is. And that's why it's important to cultivate a healthy dose of skepticism. Don't just blindly accept what others are telling you, even if they seem like experts.
Always do your homework.
Absolutely. Another key recommendation is to understand the cyclical nature of markets. Markets tend to move in cycles of boom and bust. When things are going well, it's easy to get caught up in that euphoria and assume that the good times will last forever.
Right. But inevitably, the cycle turns.
It always does. So be prepared for those inevitable downturns. Have a plan for managing those losses. And don't be afraid to take some profits off the table when things are going well.
So it's about managing those emotions, right?
Yeah.
And staying disciplined.
Exactly. It's about remembering that investing is a marathon, not a sprint.
Now let's talk about this concept that Marx keeps returning to in his memo. He calls it the importance of understanding second-order consequences. What's he getting at there?
He's talking about the ripple effects of our decisions, those unintended consequences that often go unseen or overlooked.
So it's about thinking beyond those, immediate, obvious outcomes.
Exactly. It's about anticipating those knock-on effects that might not be immediately apparent.
Can you give me an example of that, in the context of investing?
Sure. Let's say you're considering investing in a company that's heavily dependent on fossil fuels. The first-order consequence might be a nice return if the company continues to profit. But what about those second-order consequences? What happens if governments start, cracking down on fossil fuel emissions? What happens if consumer demand for cleaner energy sources starts to erode the company's market share?
So you have to think of that bigger picture.
Exactly. And this applies to all sorts of investment decisions. It's about taking a holistic view, considering the interconnectedness of things and anticipating those unintended consequences that can sometimes come back to bite you.
Right. It's like that butterfly effect, right? A small change in one part of the system can have, ripple effects that are felt far and wide.
That's a great analogy. And it highlights the importance of systems thinking in investing.
So it's not just about analyzing, individual companies or sectors in isolation.
Right. It's about understanding how they fit into that broader economic and geopolitical landscape.
Okay. So we need to see the forest for the trees. Now, Marx also gets into some pretty philosophical stuff in his memo. He talks about the importance of having a philosophy. What does he mean by that?
He's talking about developing a set of core principles that guide your investment decisions. It's about having a framework for thinking about risk, reward, and the role of the market.
So it's like having a compass that helps you navigate those complexities.
Exactly. And that compass should be based on a deep understanding of yourself, your values, your goals, and your risk tolerance.
So it's not just about like following someone else's philosophy. It's about developing your own.
Precisely. It's about asking yourself those tough questions. What do I believe about the market? How do I define risk? What am I trying to achieve with my investments? And developing a set of principles that reflect those answers.
So it's a process of like self-discovery.
Exactly. And once you have that philosophy in place, it can serve as a guiding light, helping you make more consistent, rational decisions even when the market gets turbulent.
That makes sense. Now, Marx also talks about the importance of having a process. What's he referring to there?
He's talking about having a systematic approach to investing, a set of steps that you follow consistently regardless of market conditions. This could include things like, doing your research, analyzing financial statements, evaluating those management teams, assessing industry trends, and so on.
So it's like having a structured approach.
Exactly. It's about having a process that helps you avoid making those impulsive or emotional decisions.
Right. So when the market is going crazy and everyone's, hitting the panic button, you can kind of fall back on your process to keep you grounded.
Precisely. A well-defined process can help you stay disciplined, avoid making those costly mistakes, and stick to your long-term investment goals.
So it sounds like having both a philosophy and a process are pretty essential for success in investing.
I agree. They provide a framework for making thoughtful, informed decisions that are aligned with your values and goals.
And they can help you navigate those inevitable ups and downs of the market.
Exactly. Investing is a journey, not a destination. And having that clear philosophy and a robust process can make that journey a lot smoother and more rewarding.
Now, Marx also emphasizes the importance of understanding market psychology. What's he mean by that?
He's referring to the powerful influence of emotions, things like fear and greed, hope and despair, how they impact market behavior. Understanding how these emotions drive market trends can really give you a significant edge as an investor.
So it's not just about like crunching numbers and analyzing those financial statements. It's about understanding the psychology of the market.
Exactly. It's about recognizing that markets aren't always rational. They can be swayed by emotions, by narratives, and even rumors.
So sometimes the market acts like a herd of spooked animals.
That's a great analogy. And it's why it's so important to be aware of our own emotional biases and to avoid getting caught up in that herd mentality.
Okay, so how can investors develop a better understanding of market psychology?
One helpful approach is to study behavioral economics, a field that really explores the psychological factors that influence our economic decision-making. There are some great books out there like Thinking Fast and Slow by Daniel Kahneman.
Oh, yeah, I've heard of that one.
It offers some really fascinating insights into how our minds work and how our biases can lead us astray.
So understanding those cognitive quirks can help us make better decisions.
Absolutely. Another helpful technique is to pay attention to market sentiment. Track those investor surveys, read the financial news, and just listen to what other investors are saying.
So get a sense of the mood of the market.
Exactly. And remember that sentiment can be a really powerful driver of market trends. When everyone's feeling optimistic, it can fuel a bull market. But when fear takes hold, it can lead to a sharp sell-off.
Right, so it's about reading the emotional temperature of the market.
Exactly. And finally, don't underestimate the power of narrative. Markets often respond to stories, whether they're about economic growth or technological innovation.
Right. A good story can really capture people's imaginations.
It can. And it can drive market sentiment, even if the underlying fundamentals don't necessarily support it.
So don't just buy into the hype.
Exactly. Do your own research, analyze the facts, and form your own conclusions.
Okay, so we've talked about the importance of understanding market psychology, but Marx also emphasizes the importance of understanding cycles. What does he mean by that?
He's referring to the cyclical nature of markets and the economy. Markets tend to move in cycles of, boom and bust, expansion and contraction. Understanding these cycles and being able to kind of identify where we are in a particular cycle can give us some valuable insights into potential risks and opportunities.
So it's like riding a wave.
That's a great analogy, and it highlights the importance of timing in investing. Buying at the right time and selling at the right time can make a huge difference in your returns.
But timing the market is notoriously difficult, isn't it? Even the experts get it wrong.
It is challenging, but it's not impossible. By understanding market cycles, we can at least get a sense of the general direction of the market and make more informed decisions about, when to buy, when to sell, or when to hold.
So how can investors develop a better understanding of those cycles?
There are a number of factors to consider. One is interest rates. When interest rates are low, it tends to stimulate borrowing and spending, which can fuel economic growth and a bull market. But when interest rates rise, it can slow down the economy and lead to a correction.
So keep an eye on what the Fed is doing.
Exactly. Another factor to consider is economic growth. When the economy is expanding, corporate profits tend to rise, which can drive stock prices higher. But when the economy slows down, it can lead to a decline in corporate profits and a bear market.
Okay, so track those economic indicators, things like GDP growth, unemployment, that sort of thing.
Exactly. Another important factor is investor sentiment. As we discussed earlier, market psychology can play a powerful role. When investors are feeling optimistic, it can fuel that bull market. But when fear takes hold, it can lead to a bear market.
So pay attention to those investor surveys, market commentary, that sort of thing.
Exactly. And finally, don't forget about those geopolitical events. Things like wars, political instability, and natural disasters. These can all have a significant impact on market cycles.
So it's about staying informed about what's happening in the world.
Precisely. And while predicting market cycles with, perfect accuracy is impossible, by understanding these various factors, we can at least get a sense of the general direction of the market and make those more informed investment decisions.
Okay, so understanding those market cycles is like a complex but crucial skill.
It is. And it's a skill that requires ongoing learning, observation, analysis.
Well, I think we've covered a lot of ground in this part of our deep dive. We've delved into those psychological aspects of investing, explored the concept of cycles, and unpacked some of Marx's key recommendations. But before we move on to the final part of our exploration, I want to leave our listeners with another thought-provoking question.
Okay, I'm listening.
We've talked about the importance of having a philosophy, a process, and an understanding of market psychology. But what about the role of luck? How much of success in investing is down to skill, and how much is just being in the right place at the right time?
That's a great question, and it's one that sparked endless debate among investors. Some people believe that skill and hard work are the primary drivers of success, while others argue that luck plays a significant role.
So is it nature or nurture, skill or chance?
I think it's a bit of both. There's no doubt that skill, knowledge, experience, these are all essential, but there's also an element of randomness, of being in the right place at the right time.
So how do we reconcile those two ideas, the importance of skill, but also the role of luck?
I think the key is to focus on what we can control. We can control our effort, our preparation, our decision-making process. We can't control the market, but we can control how we respond to it.
So it's about maximizing our own potential while also acknowledging that we can't, predict or control everything.
Exactly. It's about playing the game intelligently, making the best decisions we can with the information we have, and accepting that sometimes, despite our best efforts, luck will play a role.
So it's about embracing that uncertainty.
It is. It's about recognizing the limits of our control and focusing on the journey, not just the destination.
Well, that's a perfect segue to the final part of our deep dive. We've talked about a lot of practical and philosophical concepts, but what does it all mean for you, the listener, as you navigate your own investment journey? We'll explore that in more detail in the next and final part of our deep dive. So we spent the last two parts of our deep dive really unpacking this idea that genius isn't enough. We've used the rise and fall of long-term capital management as our case study. And we've talked about risk management, the limits of models, the psychology of the market. But now I think it's time to bring it all home. What does this all mean for you, the listener, as you're navigating your own investment journey?
Well, it's a reminder that, investing is more than just picking stocks or crunching numbers. It's about understanding yourself, understanding the market, and having a framework for making decisions in a world that's full of uncertainty.
Yeah, we talked a lot about humility, right?
Yeah.
Recognizing the limits of our own knowledge and being prepared to be wrong. That seems like a pretty crucial theme that's emerged from this whole discussion.
Humility is essential, especially in investing. It's easy to get caught up in the excitement, the potential for quick riches, but the market has a way of humbling even the most brilliant minds.
And that lack of humility, especially when it's combined with leverage, can be really dangerous.
Absolutely. Leverage magnifies both the good and the bad. So if you're overconfident and highly leveraged, you're essentially you're playing with fire.
Right. So how can we cultivate that sense of humility? Are there any practical steps we can take as investors?
One of the most important things is to diversify your investments, and I don't just mean owning a bunch of different stocks. It's about thinking about those underlying relationships between those assets, making sure you're not overly concentrated in any one sector or asset class.
Right. So that if one area of the market takes a hit, it doesn't wipe you out.
Exactly. Diversification is about spreading that risk, protecting yourself from those unexpected events.
Okay. So diversification, check. What else? What other practical tips can help us build a more robust approach to investing?
Well, another important element is position sizing. This refers to how much you allocate to any single investment. Even if you think you found the next sure thing, don't go all in.
Right, because even the best ideas can go wrong.
Exactly. Limit your exposure to any one position so that a potential loss won't cripple you financially.
So it's about managing that downside risk, right?
Precisely. And this ties into the idea of understanding your own risk tolerance. How much volatility can you handle emotionally? How much of a drop in your portfolio can you stomach without making those impulsive decisions that we often regret later?
Right, because we're all wired differently. Some people are more comfortable with risk than others.
Exactly. There's no one-size-fits-all approach. It's about finding that level of risk that you can live with comfortably, and that allows you to sleep well at night.
And Marx also talks about having a plan for managing losses.
He does.
Yeah.
Because losses are inevitable in investing. No matter how skilled you are, you're going to make mistakes. The key is to have a strategy in place for handling those inevitable setbacks.
Right, so you're not just reacting emotionally when things go south.
Exactly. Having a predetermined plan can help you stay disciplined, stick to your long-term strategy. That might involve setting stop-loss orders, having a cash reserve, or simply reminding yourself that market fluctuations are normal and that you're in it for the long haul.
Okay, so diversification, position sizing, understanding our risk tolerance, having a plan for managing losses. These are all like essential ingredients in a sound investment approach.
Absolutely. And they're all connected to this idea of humility, of recognizing the limits of our control. We can't predict the market perfectly, but we can control how we respond to it.
Right. And that brings us back to cycles. We talked about how markets tend to move in these patterns of boom and bust.
Cycles are a fundamental aspect of the market, and understanding where we are in a particular cycle can inform your investment decisions. When exuberance is high, when everyone's feeling optimistic, it's probably a good time to be a bit more cautious. And conversely, when fear and pessimism are running rampant, that might present some interesting opportunities.
So it's about recognizing those shifts in sentiment, those ebbs and flows of market psychology.
Exactly. But again, it's not about trying to time the market perfectly, which is pretty much impossible. It's more about understanding those broader trends and adjusting your approach accordingly.
Okay, so we need to be like students of the market.
Yes, constantly learning, observing, adapting. And this is where studying history comes in. Marx talks a lot about how many of the mistakes we see in the markets today are simply replays of past errors.
Right, those who can't remember the past are condemned to repeat it.
Exactly. And that's why it's so valuable to study financial history, to understand the causes of those past bubbles and crashes, to see those patterns and hopefully avoid repeating those same mistakes.
So it's about understanding the timeless principles of investing, those lessons that have been learned and relearned throughout history.
Yes, precisely. And then applying those principles to the unique circumstances of today's market.
Okay. So we've talked about diversification, risk management, cycles, the importance of history. But Marx also encourages us to develop our own investment philosophy.
He does. A set of core principles that will will guide your decision making. This could include your definition of risk, your investment time horizon, your preferred strategies, any ethical considerations you might have.
So it's about having a compass, a framework for making those tough choices.
Exactly. And that compass should be rooted in a deep understanding of yourself as an investor, your values, your goals, your tolerance for risk.
So it's a journey of self-discovery as much as anything.
It is. And once you have that philosophy in place, it can really help you stay grounded, make more consistent decisions, even when the market's throwing you those curveballs.
And along with that philosophy, Marx also talks about the importance of having a process.
Right. A systematic approach to researching and analyzing those investments. A checklist of sorts that helps you avoid making those emotional or impulsive decisions.
So even when everyone else is panicking, you can stay focused and disciplined.
Exactly. A well-defined process can be a real anchor in those turbulent times.
So it sounds like philosophy and process are really two sides of the same coin. They work together to guide us toward more thoughtful, more informed decisions.
I think that's a great way to put it.
And throughout all of this, we've got to remember the human element, right? We're not robots. We're driven by emotions, and the market itself is driven by those collective emotions of millions of investors.
Absolutely. Understanding market psychology, those forces of fear and greed, hope and despair, that's crucial for navigating the markets effectively.
And that's where things like behavioral economics can really come in handy, right? Understanding those cognitive biases, those mental shortcuts that can lead us astray.
Exactly. We need to be aware of those biases, challenge our assumptions, and be open to different perspectives. Remember, none of us has a monopoly on the truth, and the market has a way of humbling even the most confident among us.
Well, I think that's a great note to end on, recognizing that investing is a journey that demands more than just smarts. It requires humility, discipline, a willingness to learn, and yes, even a bit of luck along the way.
Couldn't have said it better myself.
So to our listeners, we hope this deep dive into Howard Marks's Genius Isn't Enough has given you some food for thought as you continue on your own investment journeys. Remember to stay humble, stay disciplined, and never stop learning. And as always, thanks for joining us on the Deep Dive.